The U.S. insurance industry's investments in Level 3 assets more than doubled in the last 10 years to $592 billion in 2025, with the life annuity segment driving the growth. Here to discuss a new report on the subject is Kaitlin Piasecki, industry research analyst with AM Best. So Kaitlin, could you talk about Level 3 bonds and how they fit into the overall investment strategy?
Sure. So the industry's investment in Level 3 bonds, like you mentioned, it doubled in size in the last 10 years. It rose from $238 billion in 2016 to $592 billion by the end of 2025. And as you mentioned, it's really just these life and annuity companies that are the driving force behind this growth. Investments that are classified as Level 3, they have little or no market activity, and therefore they lack observable market input, such as quoted prices or comparable market transactions. Since there isn't an active market for these investments, Level 3 assets are typically illiquid. So this is why health and property and casualty companies really have minimal exposure to these assets. These investments are definitely better aligned with longer duration liabilities of life and annuity companies.
Kaitlin, the report notes valuation risk with these investments. Could you discuss that dynamic?
Yes, so the valuation of these assets are based on complex internal financial modeling, which is heavily reliant on assumptions such as discounted rates, projected cash flows, default probabilities, recovery rates, and other model-based estimates. At the end of 2025, the fair value of 70% of Level 3 bonds held by life and annuity insurers were determined by the reporting entity or a third party contracted by the reporting entity, really making it critical for companies to have strong internal controls, model governance, and independent review processes in place.
Private equity, asset management-backed insurers account for 6 out of 10 of the companies with the highest Level 3 bond exposure. Did that come as a surprise, Kaitlin?
So since private equity and asset manager-backed insurers allocate a higher percentage of their bond portfolio to Level 3 assets when compared to other organization types, it's not really that surprising that 6 of the top 10 companies with highest exposure to Level 3 bonds were private equity and asset manager-backed organizations. These companies in particular, they're able to draw upon the investment expertise of their parent company, which allows them to invest in these harder to value assets. The presence, though, of 4 non-private equity and asset manager-backed insurers on the same list really illustrates that elevated 3 exposure is not exclusive to private equity and asset manager-backed insurers. It really just reflects the growth of private credit and structured credit within life and annuity insurers' bond portfolios.
What asset classes are Level 3 bonds mostly concentrated in?
So nearly 75% of Level 3 bonds are concentrated in corporate bonds, other financial asset-backed securities, project finance, equity-backed securities, bank loans, and CLOs. These bonds are often bespoke, less transparent, less liquid, and they generally offer higher yields to compensate investors for their complexity and illiquidity. Life and annuity insurers are really able to capitalize on these premiums because their long-term liabilities support a buy and hold investment strategy.
Thank you, Kaitlin.
Thanks, John.
That was Kaitlin Piasecki, industry research analyst with AM Best. You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.